Hello everyone, welcome to part 2 of our discussion having to do with journal entries, T accounts, the whole idea of recording and summarizing transactions. So we kind of left off, we went through several examples of journal entries and what that might look like and how they would what the debits and credits would. So now we've got some journal entries. We need to post them to the T accounts. So some principles about T accounts. First of all, if the existing company, then you have to have the beginning balances from the last accounting period before you can start making posting any of your journal entries into the T accounts. So if there was something from last month or last accounting period that needs to go in. So assets, liabilities, equity accounts are going to carry forward other than dividends. So you're going to bring that, and those are going to have a beginning balance for. And those that are on the income statement, revenues and expenses and dividends, which are not on the income statement, but the other, any gains or losses start at 0 for the new accounting period. They all start at 0 if it's a brand new company. So if it's a brand new company that's just getting started, then all of your T accounts have nothing to start with. So remember that journal entry has to change or update 2 or more T accounts, so make sure you get both sides of that when you're updating your T accounts. Don't forget one, do one and not the other. If you make your journal entries but never put them in the T accounts, that means you're not really tracking the changes. So the journal entry is what happened. The T account is how that changed the accounts and therefore the financial statements. So your system isn't complete. Now, could you go directly to the T accounts and do it without journal entries? Technically, yes. Okay, but that can sometimes be difficult to do. But if you can skip journal entries, but you cannot skip posting it to the T accounts very easily. Okay, so you could do it when you do T accounts. You could do it each way. You could write a journal entry, then put it in the T accounts. You could write all your journal entries all month long and then put them all in the T accounts at once. It doesn't matter as long as they all have been indicated, all the transactions are recorded and posted to the T accounts by the end of the accounting period, by the time you're going to make financial statements. So we've been talking mostly about what we refer to as regular entries. These tend to be transactions or events with parties outside the company. When we buy stuff, when we sell stuff, when we make payment, when we receive money. Those are all what we refer to regular entries. And that is 95% of what happens in a business are what we refer to as regular entries. They happen very much, and they happen very similar each time. And so in real life, most of those are very automated, meaning the computer can handle much of them without intervention by us, as long as they're set up correctly, because they happen basically the same way each time they happen, every day, in fact, in some cases. Now, that brings us to the second kind of entries, and that's adjusting entries. Now, don't get me wrong, there is still a debit and a credit. It's still written the same way. It still looks like a journal entry. Still gets updated to the T accounts the same way. But these usually don't have are not transactions with an outside party. Meaning we're not going to have a document typically that is going to, electronic or a physical document that's going to remind us to make these entries. These are the ones that are hard, easy to forget. They usually require a little bit more calculation, a little more thinking. This is the ones that cannot typically be done automatically by the computer. So the reason why we need them is because of what's called accrual accounting. We, as we learned earlier, need to recognize revenue when it is earned. okay, regardless of whether we receive cash. So if we have revenue recognition that's either before or after the cash is received, then you may need to make an adjusting entry. And the same thing on expense. If you use or match the expense before or after the cash is paid, then there may need to be an adjusting entry if there's not a transaction to indicate. Okay, so everything else about the journal entries is the same, and they still update the T accounts. So here's the types of adjusting entries. So accrued expense or revenue. So accruals. Accrual means owed, okay? Expense is used but not paid yet. So we've done something, we've used utilities, we've had employees work, we've borrowed money and used that money for a period of time. Any of those things that we've done and we haven't paid yet. So employees work but have not been paid, we have to record that. So if they've worked in May, and even though we don't pay them till June, because there's always a delay in when we pay our employees, right? We have to increase the expense with a debit and increase the liability with a credit in the month that they worked, in May. All right? So that's what's called an accrual, because we're recording that we owe that even though we haven't paid, because we haven't paid it yet. If it's on the other side, meaning revenue, we've done but we haven't received yet, we've done all the work but have not collected the money, that's accrued revenue. So we're going to increase the revenue with a credit and increase the asset with a debit. All right, so that's how it would work on the revenue side. So both expenses and revenues can be accruals. And often you'll see the term accrued liability when describing something that came about because of this. If you don't record that expense, then your expense is too low in the month that the employees worked, and your liabilities are too low, which means your financial statements are wrong. Deferrals is the other two types of adjusting entries. So in this case, the cash is paid now, but we haven't used the benefit yet. So prepaid insurance is the perfect example. We buy it now, record the asset, prepaid insurance, we record the cash, and then over time, it is used up. So 1 month from now, we've used 1 month. 2 months from now, we've used 2 months so far. If we only worry about financial statements at the end of the year, we just count up the months from when we bought it till the end of the year and record that much. But we're going to have to make some kind of a calculation. How much have we used up typically? And that means that we're going to reduce the asset, and increase the expense with the debit. So a used up asset becomes an expense, all right, and keeps it in balance. Cash received but have not provided services, that's unearned revenue we learned earlier. But over time, we earn that, right? So when you first receive the money, you debit cash and you credit unearned revenue, a liability. When you actually provide the services, you're going to debit, the liability, decrease. And you're going to increase revenue with a credit by the same amount. And again, you may have to make a calculation as to how much you've earned if it's something that's been earned over time. So if you receive money for a subscription where you're going to send a magazine to people every month, then you would have to see how much it is per time you deliver the magazine by dividing by 12 or 24 or whatever the time period is, and then every month or every 3 months or whatever time period you're using, you would then calculate how much you have earned of that by how many magazines you've delivered. Once you have made these adjusting entries, and remember those are the ones that are hard to remember sometimes, you put all of them in the T accounts, and that means they're adjusted. Now, there's a process called a trial balance, which is simply listing all the accounts and how much is in them at any given time. It was called a trial balance back in the old day because it was to test and see if all the debits had equaled the credit. Because the concept is we have to have the dollar amount of debits equal the dollar amount of credits in every journal entry. If that's the case, then all the debits in the T accounts have to equal all the credits in the T accounts. Which means our trial balance has to balance, because trial balance is each account and how much is in that account. And that therefore the debits have to equal the credits. Unless you have written a journal entry where the debits didn't equal the credits. Or you made a mistake along the way in posting it. So it's less about figuring out whether you have all the, numbers right, and it's more about getting prepared to make financial statements. Okay, so some people will refer to it as a unadjusted trial balance if you do it before the adjusting entries, and an adjusted trial balance. My experience is in real life, nobody designates them quite that way. We make all the entries kind of together, and we really just do a trial balance perhaps once to see that to see if it looks like we've missed anything. And from the trial balance, we make the financial statements. Income statement, then statement of equity, then the balance sheet, and always last the cash flows if that's required. Okay? Once we have the financial statements prepared and people have had a chance to look at them, get the information they need, then we get ready to start the next accounting period. We use that net income and dividends to update retained earnings, so the retained earnings becomes the ending retained earnings becomes the beginning retained earnings for the next accounting period. Revenues, expenses, dividends start over at zero like we mentioned. Okay? And then the assets, liability, capital, stock, same idea as with retained earnings, become the beginning for the next period. All right? So, let's look at one of the problems from the end of the chapter exercises as an example. So this is, like I showed you earlier, kind of one way you could lay out your T accounts using the accounting equation across the top to keep everything organized. So we're doing problem 11, which is Janet Haley and Haley's Dry Cleaners. So on December 1st, first of all, we put the beginning balances in already. Okay, so this is an existing business, so there were amounts in the assets, liabilities, and equity that came from the last accounting period. So that's what's already here. That's what you already see in the T accounts here. Making sure it's on the correct side. So the side of our T account that makes it go up is also referred to as the normal balance. So that's what we would expect cash to be, is a debit, because that's what makes it go up. We would expect accounts payable to be a debit, the normal balance, because that credit makes it go up. All right? So we're going to I'm going to skip the journal entries, just talk them through, and then put them into the T accounts as I would post them. All right? So we're prepaid rent. So we're going to credit cash $2,000. So we ask ourselves the question, what three things happened? What happened? Okay. Cash and prepaid rent were affected. Okay. $2,000 is the amount, and cash went down and prepaid rent went up. So we're going to credit cash and debit prepaid rent. That would be our first transaction. We also purchase insurance that will last 6 months. So that's prepaid insurance. Second transaction is the insurance. Yes. Okay. That means our cash is going to go down with the credit. And we're going to have prepaid insurance debit. We're going to go up by $2,400. Pay $900 of our accounts payable balance C. Okay, we're going to credit cash $900 and debit accounts payable because we're making both of them go down, right? Cash is going to go down, accounts payable down, so we debit accounts payable, credit cash. Paid off all of our salaries. Payable balance. Okay. So it looks like the salaries payable was $1,000 from last month or last accounting period. So we're going to credit cash $1,000 and we're going to debit accounts salaries payable $1,000. And that's what we kind of expect, right? Is what we owed employees from last month that we're going to pay fairly close to the beginning of the next month. All right. Bought some supplies on account. Okay, so we're not going to pay cash for this. We're going to buy it on account. All right, so we need supplies. We have that here is going to increase. All right, $2,400. And we're going to credit accounts payable, $2,400. So debit supplies, making it increase. Credit accounts payable, making that increase. Let's pay our assistant in cash. So we're going to credit cash. Okay, making it go down. And we're going to come over here to off the screen a little bit. Get it on the screen here and debit salary expense $1,000. All right, so we debited salary expense, we credited cash. So we dry clean clothes on customers on account for the amount of $8,000. Okay, so that means we provided services. That means we've earned a revenue. But we haven't got the money yet because it's on account. So we're going to debit accounts receivable. And we're going to go over here again. Okay, and credit revenues because revenues is going to go up by $8,000. That same amount, right? And collected some money from our customers. So we need to make our cash go up by a debit, $6,300. So that's a debit to cash, right? And a credit to accounts receivable, $6,300. All right. And pay tax of $750 in cash. So we're going to credit cash and we're going to debit tax expense with $750. All right, that's in the T accounts. Now, the problem said, okay, stop there. Okay, make your journal entries, put them in the T accounts, which we've been doing all the way along, and prepare trial balance. All right. And then do the adjusting entries. Again, I'm saying that most of the time in real life we don't need to pause there. We just keep doing the adjusting entries. Okay? So, it needs to adjust the entry for rent expense. Well, rent, prepaid rent was for 2 months. If you remember from our description, December and January. Okay? So, we're now at the end of December, so we have used up 1 whole month. So that's half, or $1,000. We credit prepaid rent. and debit, used up asset becomes an expense. And then we do the same thing with insurance, except insurance was for 6 months. So this $2,400 is going to be divided by 6, and we're going to use up 1 month of that. That's $400. And that's going to be to our insurance expense. Debit. So we debited $400 to insurance expense, credited to our prepaid prepaid insurance. Sorry about that. And then supplies. Oh wait, no, we owe our assistant for work that they've done. So they've worked, but we haven't paid them yet. So we're going to increase the salary expense by another $1,000. But instead of affecting cash, we're going to credit the salaries payable. And then finally, we're going to use up some supplies. And we note that on our supplies, we have $2,400, but this says that we only have $400 remaining. So that means we must have used what? The other $2,000, right? So we're going to credit supplies and debit supplies expense, which is just off for $2,000. All right, so that's the entries. Now, given all that we have, that's all we need to do, right? And what I've done in this little scenario is I have set up the formulas in Excel to do the next 2 steps for us. Here's the trial balance. Each account we're from our T account, and notice I have some of them that are zeros, which is fine, okay? And if you need accounts that you didn't have when you started, you can always add them, okay? Just make sure that they are put in on your trial balance and your T accounts. And then we were to do an income statement. So here's our income statement, revenues. Here's our expenses right from the trial balance. So the trial balance, it makes it really easy by putting everything together. Assets go together, liabilities go together, revenues, expenses, so forth. Okay, so here's our revenues and expenses right off the trial balance. Net income is $1,850. We do our statement of equity, retained earnings. Okay, we didn't pay any dividends. All right, just had the net income, so the ending is $4,150. We come down here to a balance sheet. Balance sheet comes right from the trial balance as well. And the trial balance, of course, came right from the T accounts. All right, the balance. So notice that there's just one balance for each account. Either a debit, if that's the normal balance, or a credit. You don't put the debits and the credits that are in the T account. You just put the total that is at the bottom. So you add up the increases and subtract the decreases. That's how you come up with the amount in each T account. Move it to the trial balance, then make sure that it all goes to a financial statement. All right, and it looks like we have a problem on our balance sheet because it doesn't balance. We have total assets $13,850 and total liabilities and stockholders' equity $14,850, and it's because I missed on my balance sheet, okay, one of the accounts that are on my trial balance, specifically prepaid rent. All right, so that's a good illustration. We notice we're off by 1,000, and the prepaid rent is exactly 1,000. So I'm just going to insert a row and put my prepaid rent, and put I like to use the formula, not just type the number in for 1,000. And now my formulas all add up and I have my balance sheet equal.